Jerome Powell will have a press conference in a couple hours, most likely announcing a rate hike as the FOMC meeting for March finishes up today. Now, we don't know exactly what that rate hike is going to be, but it's likely to be 0.25%. But what does that mean to you exactly? That's what we're going to talk about in this video, so stick around. Hey guys, welcome back to TipRanks TV. I'm Richard Allen. Thank you so much for joining me for another video. As the FOMC meeting for March wraps up today, Jerome Powell will be speaking very soon, and he is expected to announce a 0.25% rate hike. But what does that mean? What happens when the Fed raises rates? Why does it affect your pocketbook? That's what we're going to talk about in this video. In simple terms, when a benchmark rate goes up, it becomes more expensive for banks to borrow money, and they pass those costs on to consumers in the form of higher interest rates on lines of credit. So those higher costs will lead to higher interest rates in 5 key ways. Number 1, credit cards. Most credit cards have a variable rate, which means there's a direct connection to the Fed's interest rate hikes. Credit cards currently are between 16 and 18% variable rate, so a single quarter point rate increase isn't likely to affect card holders too much unless you have a significant amount of credit card debt. So it's something to pay attention to. If you have a variable rate on your credit card, which most people do, you're likely to pay a little bit more in interest after this rate hike is announced on your credit card debt. Number 2, student loans. Most student loans are federal-backed student loans which have a fixed interest rate. However, some private loans have a variable interest rate, and this could certainly affect your student loan payments going forward, again, by 0.25%. So every little bit in interest rate hikes affects whether your dollar goes further or not as far. So this is another way where rate hikes will definitely affect your bottom line. Number 3, let's talk about auto loans. You know, if you had to buy a car anytime recently at all, used car prices are crazy right now, going up by 50% year over year. It's absolutely bonkers right now, used car prices. And new cars are being sold above manufacturer suggested retail price, which is absolutely crazy because there is a supply and demand issue for new and used cars right now. But what does a rate hike change mean for your auto loans? A 0.25 percentage point difference on a $25,000 loan, for instance, is about $3 more per month. Now, it's probably not going to affect your decision to buy a bigger vehicle or buy a more expensive vehicle. So that's how interest rate hikes will affect your auto loans. Number 4, savings. Now, as interest rates go up, people are likely to save more because they're earning more interest in their savings. Now, when the average savings account right now offers you 0.06% on your savings, if you're saving money right now, you're losing money, like a lot of money, right? When CPI data is 7.9%, you're losing a lot of money by having it just sit around in savings and not being invested or earning other money elsewhere. So savings isn't really a great bearer of fruit for your money right now. But the idea is if interest rates are higher, people will save more money, and there is a chance that that will certainly occur. The 5th and final way is the biggest issue for interest rates in my mind is mortgage loans. A 0.25% rate hike in mortgage loans, you're going to be paying more in closing costs. You're going to be paying way more in interest over the course of a 30-year fixed loan, which was what most people are doing. Now, mortgage rates are up a full percentage point from November of 2021, now over 4%. Let me know what you think in the comment section. The top link for this video will be for TipRanks TV. This same video is available there, and that's where we can discuss all of this. I would love to hear from you over there, and let me know if you're worried about this 0.25% rate hike or not. But if it is more than 0.25%, it's likely to spook the market, and it could be scary times ahead for a lot of people. Again, 0.5% will not affect most of these things in your everyday pocketbook to a great extent, but you add them all together and all of a sudden your dollar is worth less, right? So you got to think about that kind of stuff when you're investing, when you're an everyday consumer. What the Fed does certainly affects your pocketbook. So thank you guys so much for joining me for another video. I appreciate each and every single one of you. Remember, we can discuss all of this on tipranks.com/TV. Top link in the description. We can send each other comments and reply. It's actually a pretty sweet thing over there. So guys, I'll see you in the next one.